At 6:47 a.m. Eastern Standard Time on January the 2nd, 2026, President Donald Trump posted 3 words on his social media platform that sent shockwaves through global financial markets: locked and loaded. Within 7 minutes of that post going live, silver futures had gapped up 8%, smashing through every technical resistance level that traders had marked on their charts. This wasn't a gradual climb. This wasn't a measured response to economic data. This was a violent repricing of a strategic asset in real time, triggered by the specter of direct American military intervention in the Middle East. The context behind those 3 words had been building for days. Since December 28, 2025, mass demonstrations had erupted across all 31 provinces of Iran, evolving into what analysts are calling the largest uprising since the 1979 Islamic Revolution. The economic catalyst was brutal. Inflation had surged to 42.2%. The Iranian rial had collapsed to 1.5 million per dollar, and ordinary Iranians had watched their purchasing power evaporate. But these protests quickly transcended economic grievances. In cities from Tehran to Isfahan, demonstrators were chanting "Death to Khamenei" and calling for the return of Crown Prince Reza Pahlavi. Government buildings were being attacked. Regime symbols were being torn down. The Islamic Republic was facing an existential challenge. By New Year's Day 2026, the death toll had reached at least 217 in Tehran alone, with over 2,000 arrests reported by human rights organizations. Security forces were using live ammunition against protesters. The images flooding social media showed a regime under siege, desperately trying to maintain control through violence. And then came Trump's response: locked and loaded. But the silver market's immediate reaction tells us something deeper about the current state of global financial stability. This wasn't just a knee-jerk response to geopolitical tension. This was the manifestation of structural forces that have been building beneath the surface of the precious metals complex for months. The 8% gap wasn't random. It represented the market's instant recalibration of risk in a world where the United States had just signaled its willingness to use military force to protect Iranian protesters. The implications were staggering. If Trump followed through on his implicit threat, the Middle East would be plunged into a conflict that could dwarf the regional wars of the past decade. The Persian Gulf, through which roughly 20% of global oil flows, would become a battleground. Supply chains would fracture, energy prices would explode, and in that scenario, silver wouldn't just be a safe haven asset, it would be a strategic resource essential to the military-industrial complex. What made this moment particularly dangerous was the timing. Iran's current uprising wasn't happening in isolation. It was the culmination of a year that had already seen the Islamic Republic's regional influence collapse. In June 2025, Israel and the United States had conducted a 12-day military campaign against Iran, targeting nuclear facilities at Fordo, Isfahan, and Natanz. The strikes had eliminated key Iranian military leaders and crippled the country's missile production capabilities. Syria's Assad regime, Iran's key ally, had fallen. Hezbollah and Hamas were under pressure to disarm. Iran's proxy network across the Middle East was in ruins. The regime in Tehran was not just facing domestic unrest. It was facing the complete unraveling of its regional strategy. And historically, when cornered regimes face existential threats, they don't surrender quietly. They lash out. They escalate. They try to drag their enemies into conflicts that will be too costly to sustain. Trump's locked and loaded declaration was a direct challenge to that calculus. It signaled that the United States was prepared to intervene militarily to prevent a massacre of Iranian protesters. But it also raised the stakes dramatically. If Iran's security forces continued their violent crackdown, they would no longer be facing just domestic opposition. They would be risking direct confrontation with the world's most powerful military. The silver market understood this immediately. Within minutes of Trump's post, trading algorithms began processing the implications. Military intervention in Iran would require massive mobilization of American naval and air assets. The Persian Gulf would need to be secured, critical infrastructure would need to be protected, and all of that would require silver, lots of it. Silver is embedded in the guidance systems of precision missiles. It's essential to the electronics that coordinate modern military operations. It's the backbone of the communication networks that allow forces to operate in hostile environments. But the 8% surge wasn't just about military demand. It was about the broader recognition that the global financial system was entering uncharted territory. The precedent that many traders were thinking about was 1979, when the Iranian Revolution and the subsequent hostage crisis triggered a precious metals boom that saw gold prices surge 160% within 2 years. The current situation had eerie parallels: a collapsing Iranian regime, an American president willing to use force, a Middle East on the brink of regional war. However, there were critical differences that made the 2026 scenario potentially more explosive. In 1979, precious metals were trading at relatively low levels, giving them enormous room to run. In 2026, gold was already trading near $40,400 per ounce, and silver was approaching $80. The baseline was already elevated, reflecting years of monetary expansion and geopolitical uncertainty. Any additional shock risked pushing prices into truly unprecedented territory. More importantly, the global economy in 2026 was far more dependent on silver than it had been in 1979. The rise of renewable energy, electric vehicles, and artificial intelligence had created industrial demand for silver that simply hadn't existed during the Iranian Revolution. Solar panels require silver for their photovoltaic cells. Electric vehicles need silver for their battery systems and electronics. Data centers processing AI workloads consume silver through their semiconductor components. This meant that any supply disruption would hit not just investors seeking safe havens, but entire industries essential to the modern economy. The geopolitical dimensions were equally complex. Iran's uprising was unfolding against the backdrop of what analysts were calling the great power competition between the United States and China. Beijing had invested heavily in Iran through its Belt and Road Initiative and strategic partnerships worth hundreds of billions of dollars. A collapse of the Iranian regime would represent a massive geopolitical loss for China and could trigger retaliatory moves elsewhere in the world. The risk of the Iran crisis escalating into a broader confrontation between superpowers was real and growing. This broader context explained why silver's 8% surge felt sustainable rather than speculative. The market wasn't just reacting to a single social media post, it was pricing in the possibility of a fundamental shift in global power dynamics. If Trump followed through on his threat and Iran's regime collapsed, the entire Middle Eastern order would be rewritten. Regional powers would be forced to choose sides, energy markets would be restructured, and precious metals would emerge as the ultimate store value in a world where traditional currencies and financial instruments could no longer provide certainty. The response from other global markets reinforced this interpretation. Gold jumped 4% in the same session. Mining stocks surged across the board. Defense contractors saw their shares spike as investors anticipated increased military spending. The dollar initially strengthened as traders positioned for American military action, but then began to weaken as the implications for fiscal spending became clear. Bond yields fell as investors sought safety, but the move was tentative, reflecting uncertainty about how sustained military operations would affect government debt levels. What made the silver surge particularly significant was its technical context. Prior to Trump's post, silver had been consolidating in a range between $75 and $78, with many analysts viewing the metal as overbought after its massive 2025 rally. The sudden gap to above $84 broke silver out of that consolidation and cleared the path for a move toward $90 or even $100. Technical indicators that had been flashing warning signals were reset overnight. Momentum traders who had been sitting on the sidelines suddenly had confirmation that the bull market was still intact. But the most important aspect of the 8% gap was what it revealed about liquidity conditions in the precious metals markets. The speed and magnitude of the move suggested that there were very few sellers willing to step in at current price levels. Market makers who might normally provide liquidity during volatile periods were apparently reluctant to short silver into a geopolitical crisis that could escalate rapidly. This lack of selling interest created the conditions for the kind of explosive move that had characterized silver throughout its 2025 rally. The implications extended beyond precious metals. The Iran crisis was unfolding at a moment when global central banks were already grappling with persistent inflation pressures. The Federal Reserve had been considering rate cuts to support economic growth, but the prospect of military intervention in Iran complicated that calculus dramatically. Military operations require massive government spending. They disrupt global supply chains. They create energy price shocks that feed directly into consumer inflation. If the Iran crisis escalated, central banks might find themselves forced to choose between supporting their currencies and supporting their economies. This monetary policy dilemma was particularly acute for emerging market central banks that had been accumulating gold reserves throughout 2025 as a hedge against dollar weaponization. The Iran crisis validated their strategy while simultaneously creating new pressures. If the dollar strengthened due to safe haven demand, their local currencies would weaken, potentially triggering capital flight. But if they used their dollar reserves to support their currencies, they would be reducing their holdings of the very asset that had been protecting them from geopolitical risk. For individual investors, the 8% silver surge represented both opportunity and danger. Those who had positioned in precious metals ahead of the crisis were seeing substantial gains, but the speed of the move also created the risk of a violent correction if tensions de-escalated quickly. The challenge was determining whether Trump's locked and loaded declaration represented a genuine commitment to military action, or merely rhetorical escalation designed to pressure Iran and his regime. Historical analysis suggested that Trump's threats should be taken seriously. During his first presidency, he had demonstrated a willingness to use military force against Iranian targets, including the assassination of General Qasem Soleimani in 2020. His maximum pressure campaign against Iran had been one of the defining features of his foreign policy. The current situation, with Iranian protesters being killed in the streets, created both moral and political pressures for intervention that Trump would find difficult to ignore. The economic calculations were equally compelling. A successful intervention that led to regime change in Iran could reshape Middle Eastern energy markets in ways that benefited American interests for decades. Iran possesses some of the world's largest oil and gas reserves. Under a different government, those resources could be developed in partnership with Western companies, rather than being used to fund proxy wars and nuclear programs. The potential long-term benefits of intervention might outweigh the short-term costs, especially if the operation could be conducted quickly and with limited casualties. But the risks were enormous. Iran wasn't Iraq or Libya. It was a major regional power with sophisticated military capabilities and deep ties to Russia and China. Military intervention could trigger a broader Middle Eastern war that would make the conflicts in Syria and Yemen look minor by comparison. Energy prices could spike to levels that would crush global economic growth. The United States could find itself committed to another decades-long occupation in a strategically vital but politically unstable region. These competing considerations explained why the silver market's reaction had been so violent and immediate. Traders were pricing in scenarios ranging from limited airstrikes to full-scale regime change operations. The 8% gap represented the market's assessment that the probability of military action had increased dramatically, but uncertainty about the scope and duration of that action was creating extreme volatility. As January 2nd trading continued, silver's gains began to consolidate around the $84 level, suggesting that the initial shock had been absorbed, but that underlying demand remained strong. Physical dealers reported heavy buying interest from both institutional and retail customers. Central banks in emerging markets were rumored to be increasing their precious metals purchases. Mining companies were seeing their shares outperform even as broader markets struggled with the implications of the Iran crisis. The question facing investors was whether silver's surge represented the beginning of a new leg higher or a temporary spike that would reverse once the immediate crisis passed. The answer depended largely on Trump's next moves and Iran's response to his implicit ultimatum. If violence against protesters continued, the probability of American military action would increase, potentially driving silver toward the $100 level that had seemed unthinkable just weeks earlier. If Iran's regime moderated its tactics or moved toward negotiations, the crisis premium could dissipate quickly, leaving silver vulnerable to a correction. What seemed clear was that the old rules governing precious metals markets were no longer applicable. The combination of industrial demand, monetary debasement, and geopolitical instability had created conditions unlike anything seen in previous decades. Silver wasn't just a hedge against inflation or currency devaluation. It had become a strategic asset essential to technological infrastructure and military capabilities. In a world where those capabilities could determine national survival, the metal's value was being reset to reflect its true importance. Trump's 3 words had revealed the fragility of the current global order. Locked and loaded wasn't just a threat to Iran's regime. It was a warning to all nations that the United States remained willing to use its military dominance to reshape regional balances when its interests were threatened. For investors holding silver, those words had translated into immediate wealth creation. For the broader global economy, they represented the opening of a new and potentially dangerous chapter in the struggle for strategic resources and geopolitical influence. The mechanism behind silver's explosive response to Trump's threat revealed deeper structural changes in global markets that had been developing throughout 2025. Unlike traditional safe haven rallies that unfold gradually as investors rotate capital, this surge was characterized by algorithmic buying that reflected the metal-is dual nature as both a monetary hedge and an industrial commodity essential to modern warfare. The sophistication of modern military systems had created unprecedented silver demand that most market observers failed to fully appreciate. A single Tomahawk cruise missile contains approximately 40 ounces of silver in its guidance and communication systems. The electronic warfare suites deployed on naval vessels require hundreds of pounds of the metal for their sensor arrays and signal processing equipment. The targeting systems that enable precision strikes depend on silver's unique electrical conductivity properties that cannot be replicated by other materials. This military demand intersection with Iran's strategic position created a perfect storm for silver prices. Iran controlled the Strait of Hormuz, through which roughly 40% of global liquefied natural gas and 20% of oil flows daily. Any military confrontation in the Persian Gulf would require the United States to deploy massive naval resources to keep those shipping lanes open. The electromagnetic spectrum warfare capabilities needed to counter Iran, the sophisticated missile defense systems, would consume silver at rates that current market pricing hadn't anticipated. Beyond immediate military applications, the broader implications for global supply chains were staggering. Iran's position along critical trade routes meant that even a limited military intervention could disrupt the flow of goods between Asia and Europe. Container shipping companies were already adjusting routes in anticipation of potential conflict, adding weeks to delivery times and billions to transportation costs. For industries dependent on just-in-time manufacturing, these disruptions represented existential threats that would force massive inventory rebuilding once supply chains stabilized. The electronics industry, which consumes roughly 60% of annual silver production, faced particular vulnerability. Chinese manufacturers, who dominated global electronics production, were heavily dependent on Iranian energy supplies through Beijing's strategic partnership agreements. A collapse of the Iranian regime would force China to find alternative energy sources, potentially at much higher prices, which would flow through to the cost of every smartphone, laptop, and industrial system produced in Chinese factories. This supply chain vulnerability explained why silver's surge had been accompanied by equally dramatic moves in other critical materials. The entire critical minerals complex was repricing based on the recognition that geopolitical stability could no longer be taken for granted. The financial mechanics of silver's gap higher also revealed important changes in market structure. High-frequency trading algorithms had increasingly expanded into commodities as institutional investors sought diversification. These systems were programmed to respond instantly to geopolitical events by analyzing social media sentiment, news flow, and official communications. When Trump's locked and loaded post triggered keyword alerts across thousands of trading systems simultaneously, the resulting buying pressure overwhelmed traditional market makers who might have provided liquidity during normal conditions. The fact that the gap occurred during Asian trading hours, when Western institutional participation was minimal, amplified the impact as fewer participants were available to absorb the sudden surge in demand. This algorithmic amplification of geopolitical events represented a fundamental shift in how global markets processed information. Previous crises had unfolded over days or weeks as human traders gradually assessed implications and adjusted positions. The 2026 Iran crisis demonstrated that modern markets could reprice entire asset classes within minutes of breaking news, creating both opportunities and risks that traditional investment strategies weren't designed to handle. For central banks already struggling with inflationary pressures, silver's surge presented additional complications. The metal's dual role as both an industrial input and a monetary store of value meant that its price increases fed directly into production costs, while simultaneously signaling loss of confidence in fiat currencies. If silver continued rising toward the $100 level, manufacturing costs across numerous industries would increase substantially, potentially triggering the kind of supply-driven inflation that central banks found most difficult to combat. The Federal Reserve faced a particularly difficult situation. Military intervention in Iran would require massive government spending at a time when the national debt was already approaching levels that many economists considered unsustainable. The combination of increased fiscal deficits and potential energy price shocks could force the Fed to choose between supporting the dollar through higher interest rates or supporting the economy through continued monetary accommodation. Either choice carried significant risks for financial stability. International monetary authorities were watching these developments with growing concern. The European Central Bank had been coordinating with other major central banks to develop response strategies for potential Middle Eastern conflicts, but the speed of market movements was testing their ability to provide meaningful intervention. The Bank of Japan, already struggling with currency weakness due to its ultra-loose monetary policy, found the yen under additional pressure as investors sought harder assets like silver and gold. Emerging market central banks faced even greater challenges. Many had been accumulating precious metals reserves throughout 2025 as a hedge against dollar weaponization. But the Iran crisis was forcing them to choose between using those reserves to support their currencies or maintaining them as insurance against further geopolitical shocks. Countries with significant trade relationships with Iran found their currencies under particular pressure as markets questioned their ability to maintain economic stability if their energy supplies were disrupted. The broader implications for global trade were becoming increasingly apparent. Major shipping companies were implementing war risk premiums for vessels transiting the Persian Gulf, adding hundreds of dollars per container to transportation costs. Insurance markets were repricing coverage for energy infrastructure throughout the Middle East. These cost increases were beginning to flow through to consumer prices in real time. Gasoline prices in Europe had already risen significantly since Trump's threat. Natural gas futures in Asia had spiked 30% as traders anticipated potential supply interruptions. For individual investors trying to navigate this environment, the challenge was distinguishing between temporary crisis premiums and fundamental repricing of risk assets. Silver's 8% surge could represent either the beginning of a sustained bull market driven by genuine supply-demand imbalances or a temporary spike that would reverse once immediate tensions eased. The answer depended largely on factors beyond traditional market analysis. The political dynamics in Washington suggested that Trump's threat was more than rhetorical. Congressional leaders from both parties had expressed support for protecting Iranian protesters, creating bipartisan pressure for action. The Pentagon had already begun moving additional naval assets toward the Persian Gulf. Intelligence assessments suggested that Iran's regime was increasingly isolated domestically and internationally. The protests had spread to include segments that had previously supported the Islamic Republic, including government workers. Regional allies were too weakened by their own crises to provide meaningful support. Even Russia and China, despite their strategic partnerships with Iran, were sending mixed signals about their willingness to risk direct confrontation with the United States over the Iranian regime's survival. These factors suggested that the crisis was approaching a resolution point where either Iran's government would collapse internally or external intervention would force regime change. In either scenario, the geopolitical landscape would be fundamentally altered, with consequences that could persist for decades. The Iranian uprising continued to spread across all 31 provinces, with no signs of the regime's grip loosening. Trump's ultimatum hung in the air, creating a deadline that neither side could ignore indefinitely. And in trading rooms around the world, silver's 8% gap served as a reminder that, in an age of great power competition and resource scarcity, the metals that seemed like relics of a previous era had become the currencies of the future. The only question was how much higher they would go before the crisis reached its resolution.